This video is equivalent to an entire semester of real estate education. You will be fire-hosed with information. Yet, this only scratches the surface of what is available in the real estate investing course with private mentoring included, link below.
What's up, you guys? I like long walks on the beach, but what I also like is a lot of information pretty fast when I'm trying to get an understanding of stuff. So what are we going to do? We're going to pummel you with real estate information in this video that I'm calling Everything You Need to Know About Real Estate. And if it ain't in this list, then you can find it in the real estate investing course, link below. But let's give you the overview starting right now. Real estate means property. That could mean land, or it could mean land with something on it, like an apartment building, office building, or a house. A mobile home is not real estate. 2, you can build a massive net worth with real estate, starting with pretty much nothing other than ideally a job, but you could pretty much start at any point and get into owning and controlling real estate in a relatively safe way. How do you buy real estate in a safe way? Well, ideally, you buy for less than the property is intrinsically worth. And you don't speculate on timing while at the same time trying to borrow the least amount of money that you need to. When you combine these three things, you get varying levels of risk. Every property you control has the potential for making money. There are 3 ways you can really make money by controlling real estate. The first way is, well, like I said earlier, buying it for less than it's worth. That builds your net worth pretty fast. It's the easiest and most fast and effective way to build a net worth in real estate. The second option is holding it over the long run and controlling as much dollar volume of real estate as possible, which is going to enable you to grow your net worth like planting a seed and growing a tree. The third option is by renting your properties to tenants. Obviously, you can combine these 3 things and extrapolate your net worth even faster. When it comes to tenants, you need to make sure you're actually renting to whom they say they are. That is, you need to verify their identity, social security cards, driver's licenses, run their credit, run their criminal background history, eviction history, run everything. If you don't understand this stuff, consult a professional. Next, make sure you always video or photograph as much as possible before giving a tenant a property and after getting a property back from a tenant. It's very important. Next, always make sure you properly insure your properties to make sure you're protected from as much liability as possible. Earthquake insurance in earthquake areas is recommended, but can be optional because deductibles on earthquake or hurricane insurance can be very high. So you have to evaluate the age of a building and the protections that the building has against the likelihood of a natural disaster. Some people take it as far as incorporating or creating a limited liability company to minimize the exposure to possibly other assets. But remember, always consult the appropriate professional. So if you need tax advice, call a CPA. Or my favorite method, email everybody, because guess what you want in real estate? Documentation on everything. Real estate is an asset. That means it has inherent value that can go up and down over time. When you control assets, you can take out what are called liabilities, aka debts or loans against that asset, which opens up a whole host of options, including leverage and over leverage and dangers and risks and so on and so forth. Now, when you have an asset and you have a liability against it, you can do something called calculating your equity. That is, you take your asset, you subtract the liability amount, and you are left with the equity. That is the positive net worth in that property, is an AKA for that. Now, that number could be negative. That is, if your asset's $100,000 and your liability is $200,000, you're upside down $100K. That's not so good. Now, because of risks of over leverage, and banks not getting their money, or really any kind of lender, whether it's a private party lender, which can sometimes be called a hard money loan lending you money, people who lend money usually want a deed securing their right to basically take the property if you don't pay the money back to them. The most common security instrument is a mortgage. Note, a mortgage itself is not actually the loan. The mortgage is just a piece of paper that says if you don't pay your loan, the bank can take the property from you, or the lender can take the property from you. That's why we have something called a secondary mortgage market, which means loans can be sold on the secondary market, and if you don't pay, the banks can use the mortgage to take the property, sell the property, and reimburse the investors on loans. So pretty much all real estate loans end up getting sold. The original banks very rarely hold them on what's called portfolio. Now, when you have negative equity, that is you're upside down and you want to get rid of a property, you have a few options. You could do a foreclosure, which you could just walk away from the property, or do a deed in lieu where you sign over the property to the bank, or you could do a short sale and try to negotiate a lower payoff with the bank, so that way the bank's taking a haircut, but you're helping them sell the property. If something goes through foreclosure, people can swoop it up as a good real estate purchase through what are sometimes called trustee sales or auctions. Alternatively, if you have equity, that is positive net worth after you factor in selling costs, you could do a standard sale or sometimes a trust sale. Say somebody passed away and there's positive net worth in the property to be had, and you could take money, or an estate could take their money and go invest it into something else. Now, here's the problem. Anytime you profit from real estate, or you have what are called capital gains, you have to pay taxes and you have to pay all the selling fees. This is why I usually recommend, if you don't have to sell, don't sell real estate. Keep your real estate. But there are times it makes sense to sell, like when you've fully depreciated a property. Depreciation is just a bonus tax write-off that you get when you control rental property. If you do not want to pay taxes, you have a few options. You could do a 1031 tax-deferred exchange if you're an investor, which means moving gains from one property into another property. Or if you've lived in the property for 2 out of the last 5 years in the United States, you could exclude up to $250,000 to $500,000 of gains if you're married or single. Obviously, the larger amount if you're married. There's another option too to never pay taxes, and that involves dying, but you should talk to your CPA about that one, because that's a trick that some old folks do to be able to give their estate tax-free assets. Now, here's another option for you. If you don't want to sell your real estate, but you want to take advantage of maybe some of the value that you've gained because the property went up in value, or if you've held it for a long time and you've raised rents and you're collecting more cash flow from your tenants, you could take out a home equity line of credit if you live there, a rental property line of credit if you don't live in there. You could take out private party financing, or you could refinance the property, get a new bigger loan so that you can take that money. Cool thing about taking money out via debt is usually you don't have to pay taxes at that point, and then use that money to go invest in other stuff, or buy a boat if that's what you wanted to do. The most common way to wealth in real estate is by controlling a property you live in, and then when you decide to move, or you need to move, or you want to move, you keep the first property. Then you use what's called projected rental income by renting out your house to help you qualify for the next house. Now you control real estate over the long run, ideally using good long-term financing, because what's the kiss of death in real estate? Short-term financing. In fact, that is what led to Dave Ramsey's bankruptcy. When you do this, you tend to control an asset that also helps protect you and your wealth against inflation. Assets typically do well against inflation because as things become more expensive, so does the cost of living become more expensive, and because then rental income can go up, so can property values. Everything sort of moves together. So real estate can be a very unique hedge against inflation, whereas if you kept the money in cash, you'd probably be losing money over time. This also means debt becomes easier to pay off. In fact, inflation rewards people who take out debt and punishes savers, much like the inverse, where you have deflation, which really hurts people who have debt and rewards savers. But fortunately, our government has designed our economic guidance to always focus on having at least some inflation, mostly for this reason, because if people came to expect deflation, we could go into a deflationary spiral and nobody ends up spending money, which what does that do? It crashes the economy. So focus on real estate as a hedge against inflation. Now, what's the best kind of loan? Well, the best kind of loan is the longest loan that you could get with a fixed rate that is fully paid off at the end of the loan. So that might be a 25-year fixed rate loan that's fully paid off at the end of those 25 years in Canada, or a 30-year fixed rate loan like you have in the United States. In some countries like abroad, you might only be able to get a 10-year fixed, and then you have to sort of get a new loan or switch to variable. But the longest period of time you can get, the better, especially on a fixed rate, because it really lets you plan. To me, anything shorter than a 10-year loan or note is bad. Now, how do you turn $1 into $4 or into $10 by controlling real estate? Well, with leverage. Now, here's how that works. If you put $25,000 down on a $100,000 property and the property goes up in value by $25,000, you've essentially doubled your initial $25,000 investment, obviously not considering selling costs. You could do the same thing, because in this example, you controlled $4 with every $1 you invested. You could do the same thing with a 10% down loan, or a 5% down loan, where you can control $20 for every $1 you invest. These are the benefits of leverage, which obviously come and have to be weighed out with some factors of risk. This is why it's important to buy very good deals, and we'll talk about wedge deals in a moment. Now, typically, if you put down anything less than 20%, you have to pay mortgage insurance. But fortunately, most people get rid of their mortgage insurance after 3 to 5 years. Consult your lender to figure out how you can get rid of mortgage insurance if you start with it. But usually, it shouldn't be a factor in your decision to buy or not buy, especially when you're shopping for great deals. Now, sometimes when you're shopping for great deals, you come across fixer-uppers. And you might be asking, well, where do I get the money to fix it up? Well, that's where beautiful loans like the FHA 3.5% down renovation loans can come into play, which with an FHA 203K loan, you could put 3.5% down, and then you could actually borrow fix-up money based on what an appraiser thinks the house would be worth after you put the money into the property. You'll be consulting with not only your lender, a licensed contractor, and a HUD consultant, but basically, you can renovate a property with just 3.5% down out of pocket and control a real estate fixer-upper that you can renovate your way and control all of the upside and appreciation that you were able to get by buying a good deal. So you have a whole host of options. You could do 3%, 5%, 10%, 15% down conventional loans. You could do 20% down conventional loans. Once you hit 20%, you get rid of that mortgage insurance. You could do 3.5% down FHA. If you're a veteran, you could do 0% down. And in any kind of financing, there are ways you can negotiate with the seller to have them pay for your closing costs via what are called closing cost credits. Alternatively, if you want to go into an investment style loan of anything under 4 units in the United States, that is a single family, duplex, triplex, or including a fourplex, you can usually get into these deals with 20 to 25% down at a minimum and still get a 30-year fixed rate loan. However, as soon as you go above 4 units into 5 units, 30 units, 50 units, 100 units, whatever, you get into commercial financing, which is also triggered when you get into office space or industrial properties or even certain types of land. Commercial financing is a completely different ballgame. You're not looking at 30-year fixed rate financing. Usually you're looking at 7 or 5-year adjustable rate mortgages, which are much more risky and less desirable. This is why you hear people with commercial financing always want to have an exit strategy, whereas people with the highly desired residential financing don't have to force themselves into an exit strategy plan. They can choose an exit strategy when the timing is right. See, real estate is inherently boring. You could live in it, or you could rent it out to somebody, or you could rent it out to a business, or you could run a business in it. But the basics of it are very simple. You control an asset, somebody pays you to use it, the asset usually goes up over the long run in time. This rewards the patient investor and the investor that goes in to buy properties for less than what they're worth. This also opens up a few doors, especially to hacks. Like you could house hack. That would be like saying, I'm going to buy a house, my payment is $2,000 per month, and it's a 4-bedroom house. I'm going to rent out 3 rooms for $700 a piece, and all of a sudden, all of your payments and even some extra are covered by the fact that you're renting out 3 rooms and you're essentially living for free. That's called house hacking. Always do your numbers. What goes into numbers? Well, the main things are PITI, principal, interest, property taxes, and insurance. Sometimes you'll have extras like Mello-Roos assessments, HOA dues, or sometimes you'll have mortgage insurance. Some people even extrapolate that into the hack called BRRRR, which is maybe not necessarily a hack, more of a real estate investment strategy, which is you buy a property, then you go to rehab a property because you buy a fixer-upper, you fix it up, then you rent out the property, now you have income coming in, you go to the bank and you refinance the property to pull your initial investment back out, and then you repeat the process. This can be risky though because refinancing continuously leaves you with larger debt and maximizes the debt that you could possibly have on a property, taking away some of the insulative protection you get by buying a good deal in the first place. Then in theory, you could do things like rent hacking or rent to rent, but usually this kind of stuff becomes a job where you're purposely trying to establish a lease and then you either lease it for more or you release out separate rooms, sort of like an accommodation company, which really just becomes another job. And don't get me wrong, there are plenty of ways to make money in real estate, and I encourage, if you don't have a job, to consider jobs in the real estate industry. But another famous job that people get into is called wholesaling. That is literally making a job out of finding good deals that are worth way more than what the sellers are willing to sell them for, and then matching those properties with investors that are willing to invest in them as a buy and hold or to flip them. Which, what is flipping? Flipping is buying a property that needs work for one price, say $400,000, putting say $50,000 of work into it, putting aside another say $50,000 for holding costs and closing costs, and then selling the property for, let's say, $600,000, now profiting the difference between 5 and 6. Which then, when people who do a job as wholesaling real estate start realizing the money they're leaving on the table by just transacting wholesaling deals, they start realizing, maybe I should be an investor and flip deals myself, buy and hold the deals myself, or become a real estate agent and help the people that I couldn't otherwise help sell their properties and earn a commission. As a result, most successful wholesalers don't stay wholesalers. Most bad wholesalers don't make any money. The same is true with Airbnb. Some folks take a property that doesn't have any cash flow and look and say, well, I'll get into an Airbnb and then I'll manage it and I'll do all this hospitality crap. Well, guess what happens? You just got yourself another job. Now, as a real estate investor, you get a lot of benefits because remember, your goal is to make the tenants pay all of your expenses, which what are those? Timber D, taxes, insurance, maintenance, management, utilities, reserve, and the D is the bonus for depreciation. That is another tax write-off for you, which is really just a paper loss that you're telling the IRS about. Now, there are a few things you can do with your cash flow. My encouragement is that you save it up for repairs and vacancy that come up on properties, which usually vacancy rates are very low as long as you price your properties accordingly. If you overprice a rental property, guess what? You're gonna have a vacancy. But usually it makes sense to reduce the rent to get a property rented rather than sit around and wait. Now, you can also take your cash flow and invest it into things like vacations or things that don't really create any kind of value, but my recommendation is either keep the money for when you need it or invest it into more real estate. See, here's something the typical 25-year-old could do today. They could buy a house with 10% down for $100,000 and every 7 years buy another property. $200,000, $300,000, $400,000, $500,000, $600,000, $700,000. Every 7 years would make them 69 years old, and if there were no market appreciation, they'd be controlling $2.8 million worth of real estate, only putting down $280,000. That's 10% every single time, plus some closing costs every single time. Now, if we factor in some kind of market appreciation, say 3 to 5%, what would happen to that number? Well, that number would probably balloon to well over $10 million. Somebody else can do the math on that. This is the quick run. Now, this example usually leads to a lot of cynics saying things like, oh my gosh, why would I invest in real estate for 44 years only to have that benefit when I'm 69 years old? But that misses the main benefit of real estate, which is having assets gives you access to leverage that you can now use over time to finance more investments, more creative deals, business adventures, business endeavors, whatever you want to call it. You can do a lot when you control and own real estate. So what are wedge deals? Well, wedge deals are based in the principle of always buying for value, much like the typical Warren Buffett investor that wants you to buy a company for maybe less than it's truly worth. Well, you can do the same thing in real estate, although it's very difficult to do that in stocks now. This is why real estate is one of those last holdouts where it's pretty easy to still get great deals because of the disparity of information. Think real estate markets are much smaller. You don't have the opportunity to compete with an entire global economy when you're just selling a house in a specific neighborhood. This disparity creates a lot of opportunities for people to buy deals that are either cosmetically over-improved, leading those improvements to sell for less than they're actually worth, or more commonly, a property that is selling for less than it's actually worth because of some cosmetic improvements that need to be made but haven't been made. Quick example of that might be buying a house for $200,000 that needs $30,000 worth of work, and then it would be worth $350,000. That is buying in the wedge. The third option for buying in the wedge is buying an apartment building where the rents are artificially low, which most commonly occurs when somebody owns a property for a very long time and they don't raise the rents to market appropriately. Now, what are appraisals? Well, appraisals are opinions of market value, and how can you get those? Well, by looking at what are called comparable sales. You look at the internet to see, okay, well, if a 3-bedroom, 2-bath that's 1,300 square feet is for sale for $350,000, and then over here we've got one that's sold for $400,000 and it's 1,350 square feet, and then over here you got one that sold for $390,000 and it's also 1,350 square feet. Well, that $350,000 property starts to seem a little bit undervalued, but then we realize, oh, we have to do some adjustments. Those properties that sold for close to $400K were remodeled. This $350,000 property was not. How much money do you then need to get it to that point, and what do you want to be compensated for doing that work? That brings up valuation metrics on apartment deals. Problem with apartment deals is nobody really cares about the cosmetic condition of them. Instead, what do people do? They value these deals by what's called the gross rent multiplier or net operating income to come up with their cap rate. So what is gross rent multiplier? Well, gross rent multiplier is basically this. If you have $1 million property and the total rent received for all of these 10 units as part of this one 10-plex is $100,000, then this $1 million property is selling for what's called 10 times gross. $100,000 of annual income times 10 equals $1 million. You can also do the inverse and divide to get that same number. This helps you compare. If another property hits the market for 12 times gross, why is that property so much more expensive? Is it a better quality property? You got to do the adjustments and see, or is it just overpriced? You can do the same thing by using a net operating income. Net operating income is calculated very simply. You take the gross rent, pull off the expenses, or what I like to do is usually take an expense ratio, where I'll take 35% off and I'm left with, say, $65,000 of income from $100,000 of gross income. I divide that $65,000 of now net income, or pro forma or estimated net income, divide that by the price of, say, $1 million in this case, and now what is my cap rate? It's 6.5%. That is net operating income divided by price. Then you need to decide what kind of real estate you want to invest in. Small units or big deals. Big deals are great if you're trying to gain scale very quickly, but they're very difficult to get started in. So that's why I recommend starting with the smaller deals, so then you can leverage into the bigger deals after you gain a net worth with the smaller deals. Now, as an alternative to you directly owning real estate, you could just give your money to, let's say, a fund manager, but know that they're going to generally take large fees for that purpose, and you might be better off making more money yourself if you have the time to do it. You can also buy real estate through what's called a real estate investment trust, and now you're essentially owning a stock of a company that invests in real estate. If you do decide to invest in real estate yourself, what should you be thinking about? Number one, get with an agent. Number two, get a pre-approval letter. From whom should you get a pre-approval letter? A local lender that hopefully also invests in real estate, and hopefully your agent invests in real estate as well, because they are going to be able to connect you with the people that you need to be connected with. What should you do now? Pick up the phone, call a lender, and get a pre-approval letter. Stop pussyfooting around and not getting your credit run. Instead, get in the game. Last, what should you do? You should buy the real estate investment course, because if you don't want to spend $259 on your education in real estate and understanding over 40 hours of content of everything I just said in extreme detail, all of the gaps filled in, and access to me as a private mentor, then you'll probably never be a real estate investor. However, you make the purchase, the odds of you buying are going to go through the roof.